Hello everybody, Matthew Armstrong here on day 43 of our 90-day transformation process from mediocrity to mastery. It's a great pleasure to be speaking with you today. I am very late for this training, so if you've been here live for the last 30 minutes, then I really appreciate you. We've had technical difficulties, other difficulties, when you got a 2-year-old son as well, and he's awake at this time in the morning. That also slows things down. I try and explain to him that I've got to work now, and then conk him in the room. He gets very upset. So, number of difficulties, but we're doing our best. We're doing our best, just to let you know that. So I've been talking quite a lot about. Look, you gotta. It's not just law of attraction where you ask, believe, and receive, and things don't just come to you. You gotta actually work your ass off, right? And but I also want to tell you that there's other things there as well. When we leave ourselves open to opportunities, things appear, right? And it comes down to our attitude and what we're looking for. Because two people can be presented with the same opportunity, and one person might not see it, and the other person will take it on, and it will make them a millionaire. And you never know. We're being tasked with $1 million opportunities every day, and it's those with that have a vision that will see these things, right? Those that don't won't. So this is where the law of attraction kind of comes into play, where strange things seem to happen. There was a time for me a few years ago where I was working for a charity, and we were on the streets collecting money for the charity, right? Or collecting subscriptions anyway. People to sign up direct debit to this charity, and I was actually asking empowering questions and asking questions. How does it get any better than this? Because I was out in the street 8 hours a day on my feet, just hitting people up in the street. It actually wasn't the funnest job in the world, and you get people that are very abrupt and rude and things like that, and it can be tough going. But at one point, I looked out at the ground and I noticed an envelope, a white envelope on the ground. And a ton of other people were walking past this envelope. The other people I was working with, they probably saw this envelope. They were walking up and around the area, and I'm just looking down on the pavement and seeing this white envelope sitting there. I said, it just seems a little bit out of place, that white envelope. If nothing else, I'll go over and I'll put it in the bin. Put it in the trash can, right? And so I walked over to the white envelope. Dozens of people have walked past at this stage. Since before that, I don't know. And I just put my toe and I lifted it up with my toe and I looked inside, and there was a big wad of notes in the envelope. Big wad of notes. And so I bent down, picked it up, looked all around me. No one was looking for a white envelope full of money. And I checked it out. There was over $1,000 in it, equivalent to over $1,000 in it, 870 euros, something like that, which is, I don't know, what's that, $1,200 or something like that. And there was no name on it. There was no. And by the way, a week before, I found a wallet in the street, doing the same job. I found a wallet in the street with almost 200 euros in it. $250 or something, but I had the guy's credit cards and photograph and name and everything, so I brought that to the police station, right? But this had no name, no nothing, so I said, okay, so I'm going to stand here for the rest of the day anyway. If someone comes past looking like they've lost money, then I'll go ahead and give it to them. If they don't, then I'll take it as a sign from the good Lord that I've been blessed with this money, right? And so for the rest of the day, I stood there with my eyes open in case somebody did look like they'd lost some money. No one came past, and actually the only thing that did happen was previous to that, was that an undercover policeman came up to me and started talking to me, and I could see that he wasn't interested in my pitch. He seemed distracted, and I said, "Look, you don't seem very interested. I don't even know why you stopped." And he said, "Look, I'm undercover. I'm following someone." And he said they just stopped down there for a minute, and then after a minute, I went, okay. Then after a minute, he walked off. I'm thinking, it's probably a drug dealer or something, and the guy's probably dropped that money knowing he followed. So that's what I took it that it probably was. But you know, when people say, you know, you don't actually have to do anything, things just come to you, that can actually happen. That can actually happen, and it comes down to our attitude, right? I saw something on the ground and I said, okay, well, I'll at least throw it in the trash can if there's nothing in it. You know, no one else would have even bothered looking at that because I'm not even thinking about it. A lot of people aren't open to possibilities of opportunities coming their way. You know, so they won't even do it. You know, the people I work with, they will. Why would I go look at it in a white envelope? What's going to be in there? That would have been their attitude. Why would there be money in there? I was just open to the possibility. Curious. I wonder what's in the white envelope. Let's go and check it out. Oh yeah, a ton of money in there. Much more than I got paid for standing there for a week, you know. And so it comes with our attitude. Our attitude will determine the opportunities that come our way. All right, so that's when this mystical law of attraction comes into play, is when we actually do have an attitude where we're open to possibilities. Opportunities do come our way at times. Okay, so let's get back into our reading. We're on the Demartini book of The Values Factor by Dr. John Demartini. You can get it from drdemartini.com. And we're going to read this section on page 262, the key principles of great financial masters. And that's the only part we're going to read. And then we're going to finish up there because I'm very aware that we're starting very late this morning. And I've actually got another hangout to do after this. I don't want to be late for everything this morning. You know. Then I've got a class to teach after that. So, yeah, sometimes stuff just happens. Key principles of the great financial masters. The financially wealthy pay themselves first, but the financially unwealthy pay themselves last. So whenever you receive any money, make sure you put either a minimum amount or some percentage of it, whichever is greater, into your savings and or investment accounts or into other investments. Next one, pay your personal taxes. By the inch, it's a cinch. By the yard, it's hard. Chunk your tax payments down into smaller times and sizes so that you can make sure to stay current. Next one, pay all of your payrolls according to priority. Prioritize all payments and stick to that set of priorities no matter what. When you manage your money wisely, you receive more money to manage. Pay your budgeted personal lifestyle bills according to priority. Pay your business taxes by priority. Pay your budgeted business bills according to priority. Next one. Keep your money flowing. If you would love to keep it growing, keep investing it. Next one. Appreciate a challenging upbringing when you may have undergone financial struggles. A challenging background makes you hungrier to earn what you receive. As we have seen, challenges create voids and then create values. The greater the challenge, the greater the void, and the greater the value. Next one, work in careers or jobs that you truly love, or link whatever job duties you have to your highest values so that you can be inspired and, like Warren Buffett, tap dance to work. Next one, work, 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 serve, 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 save, 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 invest, invest, invest. Next one, become a global macro visionary. Bring service to the world. Link being of service to your highest values. Next one, educate yourself in investing. Warren Buffett had read every book on investment in the Omaha Public Library by the time he was 11. The earlier you begin studies, the better. If you truly begin to value wealth building, you will build it. Next one, study probabilities, statistics, and money management principles. When you truly value investing, you will study its laws. Next one, mentor others on investing so you will learn by teaching. Next, don't pretend you know everything about investing. Remain humble and open to continued learning. Likewise, don't always think you are right. Pride goes before a fall. Next, don't venture beyond your sphere of knowledge until your sphere of knowledge extends beyond your venture. Study investments class by class. Next, save before you invest and before you speculate. Build a stable foundation so that your building won't sway. Next, be a long-term investor more than a short-term speculator. Stay the course for 20 or 50 to 50 years. That keeps greed and fear out of investing. The time in the market is more important than the timing of the market. Be a patient investor, not a daily trader who seeks immediate gratification. Get some fresh air. Know the downside as well as the upside of each investment. When you live according to your highest values, you will embrace both sides equally. Next, maintain discipline. Avoid chasing fads or following fashions. Be a principled and disciplined investor, not a gambling opportunistic one. Next, stick to the fundamentals. Markets regress to a mean regardless of cycles. Next, make large, significant investment decisions only when you are certain that markets are at extremes, generally every 5 to 10 years. The average market cycle lasts between 5 and 10 years. At those points, be a contrarian. Every manic has a panic. In other words, when the market is at its peak during a so-called bubble, that is usually a wise time to sell, even while everyone else is buying. When the market is at its lowest during a crash, that is usually a wise time to buy, even while everyone else is selling. Wait, and wait until you can see a great bet. Patience is wisdom. Buy and hold value with patience. Next, diversify to reduce volatility. Don't put all your eggs into one basket, even if your own company. Select a few investments and hedge your bets. Balanced portfolios become timeless. Next, unless you are an investment specialist, consider buying the whole haystack in an index rather than spending time and money searching for needles. An index is a collection of stocks bundled together by a financial firm. It is generally held for at least a year, enabling you to take advantage of long-term capital gains. Next, seek low-cost index fund investments to keep the cost of investing and trading down. Performance isn't the only thing that counts. The expenses are often just as significant. Next, beware of overpriced, highly volatile, unregulated hedge funds. Next, work your way up the investment class spectrum, not down. Earn the right to risk. Next, beware of unrealistically thinking that you will pick only winners or stocks that will only rise in value. You will pick at least some losers as you invest, and you must budget for that. This is why I advise progressive investment. When your wealth is small, invest conservatively in an interest-bearing account or a CD. When your wealth is greater, invest in an index or mutual fund or some other form of stock accumulation that hedges against risk. When your wealth is greater still, you can take greater risks because you will have a financial cushion to soften the blow of the inevitable losing stocks. Next, invest in companies that are managed well. People make the difference. Next, beware of forecasts and predictions of markets. They can be biased gambles. Remember that the people who make the predictions have their own biases. Next, concentrate your efforts on what you can control, notably keeping costs and taxes to a minimum. Next, master the science of asset allocation. Keep to the big picture and to your overall investment strategy. If you are continually buying and selling, you raise the cost of investment. If you're able to hold on to your assets longer, you benefit from capital gains. Sometimes you need to move your assets around to respond to a change in the market. But if you master science of when and how to do this, you will save yourself money in the long run. Next, review and rebalance your investment portfolio after each year to maintain your asset allocation according your strategy. Work with an advisor to determine the strategy that makes sense for you, and then make sure that you decide rather than allowing the market to do so. Don't let your portfolio drift. Have your advisor explain a plan to you and make sure that conscious decisions are being made for every investment. Next, maintain some liquidity and be conservative. Don't ever lose sleep over trying to gain a few extra percentage points. It is better to take fewer risks and feel more confident than taking big risks that will keep you up at night. Keep plenty of liquid cash on hand so that you can respond to emergencies and opportunities as they arise. Next, what the wise man does in the beginning, fools do in the end. Next, hedge against all extreme outcomes. Big biases can destroy portfolios. For example, if your bias is toward tech stocks and you have not balanced your portfolio, you are vulnerable and likely to lose a great deal and destroy your stock portfolio. When any tech bubble bursts, as it did in the 1990s, or if your bias is toward real estate and then the real estate market crashes, you could destroy your portfolio unless you balanced it with some investments in other areas. Next, know the risks and dangers of leverage. Leverage is a financial term for any technique used to multiply gains and losses. For example, if you wanted to start a business, you might leverage the value of your house by taking out a mortgage on it and using that money to start your business. Now your house is even more valuable than it was before because it is both a valuable piece of real estate and the foundation of a profitable enterprise. However, as you can see from this example, leverage possesses risks as well. If your business fails, you might also lose your house. Leverage multiplies your potential gain, but it also multiplies your potential risks. Understand leverage thoroughly in your business dealing and take no unnecessary risks. Next, set realistic objectives and lower your unrealistic expectations. Beware of overzealous returns. Next, factor in inflation to determine real returns and real wealth. Over the long term, currency movements cancel each other out, so keep an eye on foreign investments. Next, develop an investment team. Next, use debt sparingly, if at all, and only if with long-term low fixed rates and if your debt produces more than it costs. For example, suppose you borrow money at 6% a year to start a business that in 3 years has a return on an investment of 24%. Because your business is bringing in far more than the interest rate on your debt has produced more than it costs. However, if you borrow money to buy a car or put some new clothes on your credit card, your debt is costing you money and it is not producing any money. Unless your new car can truly be demonstrated to assist you in making you more return on your investment than the car loan cost, consumer debt is one of the reasons that many people find it difficult to get ahead financially. They are spending money on debt that does not produce any income. Next, be reasonably calm and prepared for ups and downs. That is just the feedback that the market is giving you. Next, develop a creative capitalistic mindset that includes accountable philanthropy. Philanthropy can be very meaningful use of your money, but it must be accountable philanthropy, whereby the money that is distributed makes recipients accountable, responsible, productive, and dignified, rather than fostering dependency, irresponsibility, and shame. All right, that's it. That's really sound advice there, right? And that's worth reading over, I don't know, a few dozen times. And things will start to sink in, and then when things come up, you'll remember what you read and the advice that Dr. Demartini gave you, right? What we're going to read tomorrow is why you're already a billionaire. This is a really interesting next section which we're going to read tomorrow. But we're going to end our call right now because that's just a ton of information I've just given you there, and you probably it's worth either, if you haven't got the book yet, is watching it again and just taking notes as you go, writing down bullet points, or just reading over the book again a number of times and even printing that out and putting it up on your wall so you get to read it and see it and know those simple principles and investments that's going to keep you on the right track. Okay, thanks so much for watching, and if you're looking for a vehicle for your financial freedom, you probably want to click on the link below. That's going to take you to a page of mine, and you are very welcome to join me in creating financial freedom online. And even if not, you can also put your details in, and I'll send you regular updates so you're on my email list. Please do that. That'd be great. Okay, make sure you tune in again tomorrow. Do my best to be on time tomorrow. See you then.